So I have received a few requests regarding a few principles that was told in chapter 1 and 2. Basically, for chapter 1, there are residents, non-residents, deemed residents, and there are non-residents, as well as dual residents, sort of things, right? So I'm gonna go through those kind of principles. Hopefully, it will help you to have a better understanding. Okay, so the one I opened is a PowerPoint. You will see all those PowerPoint in Moodle. So if you have any questions, you can open the Moodle and take a look at the PowerPoint. They actually have highlighted all the important principles. So you're not reading the whole book. You can have the main point or highlights. If you have question regarding specific highlights, you can go back to your book and looking for the detail, and also doing the exercises. We're gonna doing some exercise according to all those principles we're gonna talk about. Okay, so I'm gonna start it with the residence of individual. Just pay attention. One thing is the PowerPoint and talk about residence first, and then the non-residents. But from your textbook, I believe it talks about non-residents first and then residents. Okay, so just watch out for the way they just presented. Okay. So regarding the residents, as we know that all the Canadian residents needs to file their income taxes. So if a person is considered to be a resident of Canada in a specific given year, that person will be subject to Part 1 for that year on all source of income, regardless where those income is earned. So if you're considered to be a resident of Canada, then you need to pay all the income taxes, no matter where you have earned these income taxes. For example, you are a Canadian citizen, you're a Canadian resident, then you need to pay Canada income taxes if you make money from states. So watch out for all those details. And then in the same time, if a person is a non-resident, the Part 1 tax will only apply for Canadian employment income or Canadian business income and gain on disposition of taxable Canadian property. So it's for non-residents, you're only capable for the Canada side of your income. Now we talk about the residence of individual. The definition concept is the average Canadian individual whose job, family, dwelling place, and other personal property are all in Canada. He will clearly be a Canadian resident, and as a result, he will be liable for Canadian taxation on his worldwide income. So that's the definition for the residence. Then we need to define, how are you going to define if a person is a resident or not? The Income Tax Act, they gave extensive guidelines for this kind of area. So the most important factor to be considered in determining whether an individual living in Canada remains resident in Canada for tax purpose is whether this person maintains residential ties with Canada while on board. So we're looking for the residential ties. What are those residential ties? So there are three, right? The three main ties. One is dwelling, and second is spouse or common law partner, and third is dependent. So unless an individual severs all significant resident ties with Canada upon leaving Canada, the individual will continue to be a factual resident of Canada and subject to Canadian taxes on his or her worldwide income. Now we talk about those three ties. Dwelling. We understand if an individual maintains a dwelling place in Canada, this can be a permanent house or rent or buy. Okay. And only one exception to these rules is if a individual who leave Canada and he rent out a formal place to an arm's length party. In this type of situation, only a Canadian resident may not be considered a residential tie. Okay, so you rent your formal house to an arm's length party. Okay, for example, your brothers. You rent your house to your brothers. So this property, if you left Canada, and this property cannot considered as a significant ties to ask you to pay income tax or Canada income tax. Second, spouse or common law partner. So if an individual has a spouse or common law partner who remains in Canada, it will generally result in the individual being considered a Canadian resident. See if you have a job in States, so you're living to States to work, but your wife and your children stay in Canada, then you're considered to be a resident in Canada. And then dependents. So if your children, like small children or minor children who remains in Canada, will generally result in an individual being considered as a Canadian resident. So except for those three main significant ties, we also have some secondary residential ties. Refer to this PowerPoint as other residential ties. Okay, so the secondary residential ties including personal property, like furnitures or cars, clothes, and vehicles. And social ties, which means that your memberships in Canadian recreation or religious organization. Economic ties, say like, or you have employment with a Canadian employer and you are actively involved in the Canadian business activities. Third tie, we see landed immigrant status, where you had a work permit in Canada. You still keep your health card, your driver's license active. You still register your vehicle, so you still have your vehicle registration in Canada, your Canadian passport, and also you are a member in Canadian unions or professional association. Like the example was showing that if they're a CPA membership, they keep active membership in Canada. So those are the secondary residential ties. But the S5F1C1, so this rules saying that all these secondary ties must be looked at collectively, and that it would be unusual for a single secondary tie to be sufficient for an individual to classify as a Canadian resident. For example, if you take a look at a person and seeing if he is a resident of Canada, then you have to take a look. You say, okay, so he has a Canadian passport, and then that's it. He's a resident of Canada. That's not right? Because you cannot just take a look at one single residential ties as a decision making. We could have examples on this. Okay, so I opened a textbook from the e-text from Pearson. This is, there is a exercise 1-6. It talks about a residential type. So at the end of the current year, Simon departed from Canada in order to take a permanent position in Ireland. He was accompanied by his wife and children, as well as all of his personal properties. Due to depressed real estate price in his region, he was unable to sell his residence at a satisfactory price. However, he was able to rent it for a period of 2 years. He also retained his membership in CPA in Ontario. After his departure, would he still be considered a Canadian resident for tax purpose? So we just talked about their major tie with dwelling, spouse, or dependent. And then his spouse and children were living with him, right? So that is not in there. Dwelling is the residence place. So the CRA could see that this person, Simon, he is a Canadian resident because he still keep his house, his dwelling place in Canada. But when you take a look at specific situation, the reason is he keeps his dwelling place is because he cannot sell it, right? So by consider the specific situation, and we could see that he's not a Canadian, you could argue that he's not a Canadian resident in order to pay the income taxes, because he's not able to sell the price, but he was willing to sell the place. And also the only one for membership in CPA in Ontario. This is a secondary residential ties. And as we just mentioned before, oh, just right there actually. So we cannot take a look at a single, excuse me. So we cannot take at a single secondary types to be sufficient to decide if the person is a Canadian resident or not, right? So we should have enough evidence to show that he's a Canadian resident. So for this specific situation, we could argue that Simon is not a Canadian resident.